Before selling your investment, ask yourself these questions. At a time when the economy isn't feeling well or the stock market takes a plunge like it is right now, it's very easy to get emotional. I mean, all you see is your investments getting bloody red day by day. If it makes you feel any better, you're maybe down just a few $1,000s or tens of thousands of dollars. But imagine how someone like Warren Buffett is feeling right now. He's down billions of dollars. But someone like him doesn't panic because he has faith in the global economy. The world has gone through several wars, recessions, famines, viruses, and political crises.
Getting a good picture of everybody so we look nice and handsome and thin.
Beautiful.
Perfect.
잘생기게 아름답게 찍어달라고.
And guess what? The economy gets past it and keeps advancing no matter what. You know what it would take to really take it down permanently? Maybe a big asteroid that causes something destructive like the movie 2012. But before I tell you the 5 questions you should ask yourself, here are 2 reasons that you should be selling on almost any occasion. First is that you need the money to pay for necessities like food, shelter, transportation, and even the internet bill. The second reason is that you don't have any emergency savings in the event that you lose your source of income or there's some major expense that happens, like a car repair or medical bill. Usually savings should be around 3 to 6 months worth of expenses in cash that you would ideally keep in a high interest savings account or in the basement for the rats to eat like the Italian mafia. So if you spend $2,000 per month, then you should keep somewhere between $6,000 to $12,000 depending on your comfort level. Note that all these 5 selling questions should be deal breakers, not something small like 5 to 10% investment losses. So before we start, smash the like button and subscribe to my channel. Let me know in the comments below what's the last investment that you sold. For me, it was Subaru because I felt that their sales growth was diminishing and they weren't keeping up with the whole electrical vehicle dance-off. The first question is, did you lose confidence in your investment for the long term? Perhaps something changed your way of thinking that suddenly you lost faith in the business's products, services, or ability to execute. For instance, I used to be a big believer of Canadian Tire stock back in 2015, but I started to notice that their category of products could be sold by anyone, and Amazon was only getting stronger in Canada. As good as they were at executing their plans and having brand loyalty with their customers, it's definitely an uphill war that I didn't want to be a part of as an investor. Nothing had really changed about the company, but it was something at the time that I had thought about personally with my observations over time. The second question is, did your initial investment reasoning actually change? Usually there's at least one core reason as to why someone would buy an investment, be it the consistent dividend income or growth plans. Once the very reason you bought the investment changes, then you should really assess whether you should keep the investment. For instance, a lot of people buy Apple because they're the top in mind brand for selling smartphones. The moment they lose this position to the competition, this reason might be big enough to change your mind. Or maybe you buy Apple because Warren Buffett bought into it and your strategy is to follow him. So if he sold it, I guess you would too. Or perhaps in terms of growth, you expect new iPhones every year, but maybe they suddenly stop because they're running out of ideas. The third question, is the valuation stretched? In one of my previous videos, I talked about valuation of companies being a reason to buy and sell out of investments even if they could be good ones. Even if we're talking about a great car like a Ferrari, when the selling price gets way too high above its more realistic value, it can warrant a sale. In contrast, when the price gets too low below its realistic value, it can warrant a buy. The same concept applies for anything from Drake concert tickets to stock market investments. A higher price than normal should be a sell, and a cheaper than normal price is a buy. If you want to learn more about valuation and my quick method of doing so with stocks, then check out the video after. The fourth question is, do you expect something bad to happen that hasn't been reflected yet? Usually the stock market runs on fear before terror actually comes. Oftentimes the terror is a false alarm, so markets rebound. But sometimes it actually comes, and it feels like the end of the world. But even then, it tends to end pretty fast and things go back to normal. Usually if you have some information, hopefully not illegal, that might save you from a big downfall in the investment, then you can act on it. Examples can be that you notice that people are scared of losing their jobs at a company because they have nothing to do. Or you see an early Facebook event calling for a strike at a company. Or maybe you frequently go to the mall and realize that no one is buying this brand's products anymore. or you simply feel that there's too much hype and expectations going on for what the investment can bring to the table. On a charting perspective, I feel that investments that move during the year above a 45 degree usually have some really high expectations baked into it. The last question is, are there better investment opportunities? Perhaps there's nothing wrong with your investment, but you found something else that might give you more return. Maybe your current investment might only have a 10% upside for the year, but you found something else of similar risk profile or less, and you have confidence that it has a 30% upside. The new investment opportunity can be worth the switch. Professional investors do this all the time, especially for companies within the same industry. It's why someone could be buying Lowe's and selling Home Depot when you're comparing potentially 20% upside returns to 5% for the year, according to Wall Street analysts. So that's it in terms of the 5 questions. I would encourage you to revisit this video every time stocks are plunging, or you feel the need to sell your investment and want a second opinion. If you enjoyed this video, smash the like button and subscribe to my channel. Don't forget to comment on what was the last investment that you sold.